So let's stick to where we were. So initial discussion was on FRA,
Right.
and we discussed what a FRA is, what is the motivation of doing so, and how do we do that, and what is the benefit and the flip side of entering into an FRA, that we lock in the price. And then
Yeah.
we said, instead of a FRA, which is a OTC product, how about that we get into futures, right? And I gave a term as STIR, futures.
Yeah.
And then we also solved the question, just to get into the same rhythm. Let's just go back to the same question, right? There's one more part that I wanted to do, and I really wanted to solve that instead of telling me conceptually, because the more you scramble, the more you do questions, the more you'll get our hands on, right? Instead of, because sometimes we just think that we will be able to solve it, but when it
Yeah.
comes to really solving it, we make some mistakes, right? So I hope we did the first part of it that day.
Yeah.
I wanted to read this question again, and then let me just resize a little bit. And I want you to, one second. And I wanted to handle, is it visible or is it too small?
No, it's visible.
I wanted to read this question. We solved this one on Wednesday, I guess. I wanted to read this part B,
Yeah.
and I wanted to really calculate the number and tell me the answer so that you would know on what you're doing exactly.
Yeah. So basically, first part is the interest received on the deposit,
Want to be?
which will be 6.5 minus 0.25, which is 6.25 into 20 into 90 divided by 360. So
That number would be?
that will be,
Just one thing in between. Are you using mobile for these calculation, or are you using the actual calculator?
I'm using my, I should get the actual calculator. I don't have it right now. It's with me only, but I just don't have it right now.
So it's important that you use the calculator
Got it. So
and
it's
not taking the phone.
312,500.
Okay, perfect. And will there
Um,
be a profit on futures or loss on futures?
there will be a loss because the price of the futures at that date will be 100 minus 6.5, which is 93.5, and he bought it for 95. So it's going to be 1.5 into the number of. So how will it be? 1.5 into?
On how many dollars, or on how many contracts did he buy?
He bought 20. 20 he bought.
Like 20. And what is the change in 1 bips? So this 1.5 is actually 150 bips, right?
1.5 is 150 bips, right? Right.
And the change in 1 bips is $25.
Change in 1 bip is $25. Okay.
Look at this. Look at my cursor.
Yeah.
So it is 150 multiply
So
25.
$3,000?
No, 150 multiply 25 multiply 20 contracts.
Into 20. Got it. Yeah, it'll just be 150 into 500.
How much is going to be? Sorry.
75,000?
Okay. What would be his total return?
This will be a loss. Total return will be basically 312,500 minus 75,000.
And which is going to be how much?
237,500.
Now, before we proceed, I just have one question for you.
Yeah.
That while solving this question, and the reason why I made you solve this question is I understand you are okay with numbers now and you know how to solve this question now. But you solved one part on Wednesday,
Mm.
Tuesday. And when you were reading part B, did you realize and did it come to your mind that in this case the price was quoted 3.5
Yeah.
and this time 6.5, but no matter where the interest rate would move,
Uh,
since he has got into FRA,
mm-hmm.
the total amount that is going to receive or the total return that is going to receive will still be the same,
Mm-hmm. I
right?
didn't realize. No.
So you also realize that this is the amount that you got, right?
Yeah.
So I'm saying the idea here is that obviously we should know how to solve this question,
Yeah.
but we should also be cognizant of the fact that FRS says that you are locking the price, which clearly means that whether you gain profit or loss somewhere in between, but the end result will always be the same because that's a reason of getting into an FRA,
Mm.
right? So this
Mm.
time where the interest deposit is more than expected,
Yeah.
you actually make a loss on the forward contract, effectively ending up the same amount as you got when the interest rate was 3.5.
Mm.
Make sense?
Makes sense.
See. So the deal here is that we thought that could move, the interest rates could move, and we really wanted to lock in the interest rate for future,
Mm.
right? Now, when it comes to fixed income futures, when we have a FRA and we can lock in the interest rates, when we think that the 3 months interest rate or 6 months interest rates could be something else, and we want to hedge that,
Mm-hmm.
right? So we got into an FRA. Now think about this. You have some fixed income bonds. You are long on some fixed income products, and there you want to hedge your position.
Mm-hmm.
So you might think that Ankur, then I can get into fixed income futures similarly,
Mm.
because the idea is just to offset a position,
Yeah.
right? But there's a problem. There's a problem here, and that problem is that in these standard FRAs,
Mm-hmm.
there was not much movement of interest rate first, and the reason is we assume that we want to borrow something 90 days from now,
Yeah.
and we set an interest rate which is fixed rate.
Mm.
Obviously we are thinking that the interest rate would change, but the assumption here is that after 90, we don't know the price as of now,
Yeah.
but we will assume that there will be some price in 90 days that we're trying to fix.
Yeah.
But think about this, in the real world, practically, the interest rate is changing every day,
Yeah.
right? And you might then think that, Ankur, still okay, let it change. I want to look at my 90 days interest rate and take it from there. I can lock it at that price.
Yeah.
But the problem with fixed income is that interest rate also impact cash flows,
Okay.
right? You know that a present value of a bond is being given by the coupon upon 1 plus I to the power n.
Mm-hmm.
So if the interest rates are going to change,
Mm-hmm.
then my costing, my present value, and my other parameters are also going to change, which means it's not so easy to get into my fixed income futures. One thing.
Mm.
Second thing is, when it comes to fixed income, for a longer maturity bonds, if it is 2 to 3 years, it's fine.
Mm.
Longer maturity bonds are illiquid.
Understood.
Longer maturity bonds are illiquid. And third problem is that when it comes to futures, obviously they are standardized products, right? And you might not get a bond which is in line to your expiration of what you want, right? So what happens is, so let's just try to understand these. We talk very generically of how our fixed income really works and what is the problem of getting into fixed income. But let's just try to understand some nuances on how do we work around it, and what if we want to get into a fixed income contract, a futures contract. So how does it work? Point here is, when it comes to fixed income, assume that we are getting into fixed income futures, right? And obviously there are, when it comes to futures, there will be treasury bonds that we can short. Okay. And a lot of times, actually, the a lot of times when you get into a fixed income futures contract,
Yeah.
the settlement happens somewhere in between most of the times, right? Basically netting the position overall, right? So a lot of times the contract close before the expiration, and it doesn't really go till the expiration. But
Yeah.
and if such things happens, obviously you know the concept of netting, right? That whatever the price would be at that time, you know how it is, right? You have this
Yeah.
contract 90 days for another 180 days. It's really around, let's say, 19 other days. Basically, this is 270 and this is 180, right? So you basically get into another contract which is offsetting. Effectively, you logged in at a price today.
Yeah.
You make your payments here only, right? And then you close off. Basically, you know what the price would be at that time, and then the logged in price, you bring them back at the present value, and then you close the deal. You know all of these nuances, right?
Yeah.
Okay. When I say that you know all of these things, in case you don't know, just let me know. That Ankur, I don't know.
No, this.
But the problem is, how about that? How about that someone does not really close this transaction over here? Does not. In that case, think about this. So if I am long a position, and to hedge it, if I am short my fixed income future, right? So does it mean that I actually have to sell futures, or basically I have to give treasury future bond? Basically, when I say that I'm selling the futures, basically I'm selling a treasury bond for future.
Yeah.
Does it make sense?
Yeah.
When we short something, I say that I would be selling it.
Yeah.
Right? When I'm short a contract, so I'm saying that at the end of the period, I'll give you this bond. I'll sell this bond to you. And the person who's long that contract will be getting the treasury bond from me.
Yeah. Right.
So far, so good?
Yeah.
Now the bigger question is that I have to sell a bond at the end of the period, right? The treasury bond. The question is, which one would I sell? Which one would I sell? So here's the thing. So it assumes the whole the world assumes that the treasury bonds interest rate or the coupon rate is 6%. Is a basic assumption that the treasury bond interest rate is 6%, right? So what they do is they calculate some kind of a conversion factor.
Okay.
they calculate some kind of a conversion factor, right? And obviously, when I want to sell something, I want to sell something which is cheapest to me.
Yeah.
Everybody wants to sell. भाई किसी को सामान देना है तो चाहेगा वो उसको बेकार से बेकार सामान दिया जाए, right?
Yeah.
When I say it has to be cheapest to me, or I would use the word cheapest to deliver, right? So basically, I'm talking about too many things right now, but let's just try to understand what is happening here.
Yeah.
The point is, my first point is that in terms of fixed income futures, we are talking about a situation where you really want to give away a bond at the expiration and netting is not happening. We are considering a situation where you are giving away a bond to the person and netting is not happening. So we're talking about this point, right? Second, if I really have to give away a bond,
Yeah.
and I have multiple options, I will think of an option which will be cheapest to me to deliver, so that first I can say that my losses are minimum, or maybe to say my profits are maximum.
Yeah.
Think about this, because if I really want to give away a bond, I'll try, if I'm making a loss, if I'm making a loss in the whole transaction, I'll try to minimize my loss.
Correct.
If I'm making a profit in the whole transaction, I'll try to maximize my profit. Simple logic.
Yeah.
But then the question is that how are you really going to understand which is the bond that you're going to deliver? And the assumption here is that the bond that I'm going to deliver will be called as CTD, or the cheapest to deliver bond. Right? So the question might come up, and we're going to talk a lot. We are going to do a lot of questions where the idea is that they would want to know which one is they give you a lot of information, bond number A, bond number B, and we'll have to do some calculations so that we would know which bond will give me the minimum loss or the maximum profit, and that's the bond that we're going to deliver. And that bond will be called as cheapest to deliver bond. Any specific bond is not the cheapest to deliver bond, but any bond that can give me the minimum loss can be called as cheapest to deliver bond.
Okay.
Is that okay for now?
Yeah.
Now, as I said, that to calculate my cheapest to deliver, there's something called as conversion factor. So can I say so is it okay to say that, let's say every bond, let's say I have 4 or 5 bonds. And every bond has, let's say, a face value of $1, right?
Yeah.
When I say that it has if I have to calculate my conversion factor, and I'm assuming it is 6% for treasury bonds, right? So I'm discounting at 6%. So can I say the bonds which have a coupon of more than 6% will have a conversion factor of more than 1?
Yeah.
Coupons will have that bonds that have a coupon of 6% will have a conversion factor of 1.
Yep.
And futures that have coupon of less than 6% will have a conversion factor of less than 1. So far, so good?
Yeah.
Right? So one thing, because why we are doing this? We are doing this because we are assuming that it is 6%, but then different bonds will have different coupon rates.
Yeah.
Right? And we are calculating a conversion factor so that we would know that this is the conversion factor that we will be able to pay. And now that we have a conversion factor, we don't have to look at every bond individually. We'll just use a conversion factor to calculate my overall amount that we're going to pay. In a way, it is a good way to say that we are normalizing everything so that will bring everything at par. Right? Okay. So can I say now, if we understand this,
6% is the current treasury rate, or which rate?
the 6% it is 6% it is the government bond coupon rate. It is a standard government bond coupon rate that is being used. Although
today, or the like a forward curve?
No, not today, not forward curve. It's like a standard government bond coupon rate can be assumed at 6%.
Got it. Okay.
Right, and obviously I'm going to talk about why this 6% is not perfect. We'll talk about that. Right. So can I say that a person who is short, obviously he'll deliver the bond and he will receive, right? And he will receive can I say that the future settlement price right? And this price, whatever is being told you, it is being given in terms of par value, basically per par value, right? For every treasury bond that we will sell, they have a face value of 100,000. You have to remember this, and obviously the conversion factor. Okay. So the person who is short and who would be giving away the bond, he would be getting the future settlement price, because this is at a per par value. So divide by 100, multiply for a treasury bond, the face value is 100,000, multiply the conversion factor. But we are assuming here that there are no, and the delivery is happening on the coupon date or the expiration date. But just in case there's a transaction that is happening somewhere in between, basically this is our contract and we are looking at expiration, but obviously the bond that we are handling would have different time to maturity and different coupon dates. Right? We are looking at this one because this is our horizon, not the bond's horizon. I'm trying to settle something for 270 days for now, but maybe that 270th day could be a coupon date or could not be a coupon date for that bond. Right? So in that case, in case it's not a coupon date, then we will also have to include any kind of accrued interest that has been accrued over that period.
Yeah.
Does it make sense?
Yeah.
So the total amount that is being received will be, if I'm calling it as A, then it's going to be A plus accrued interest. Are we okay so far? Sure?
Yeah.
Now, it is one thing that we also need to understand that and this is something that is theoretical. Why I'm calling it as a theoretical? Because it is important to understand that this conversion factor is not perfect. Although we will be using in the exam and will be using it for calculation, but just letting you know theoretically that conversion factor is not perfect. Why is it not perfect? Because we assume that the treasury bond interest coupon rate is 6%, and we will be discounting it at an interest rate of 6%. This is how we calculate the conversion factor. But just think about this. Do all the bonds have the same maturity?
No.
Different treasury bonds will have different coupon rates, right? And for different time to maturity, they have different interest rate, right? So which means that when you are trying to calculate the conversion factor, although you will never be asked to calculate the conversion factor per se, you will not be asked to calculate the conversion factor. You will be asked to calculate this where the conversion factor will be given to you in the exam. So that way you don't have to do any calculation, but just to let you know theoretically that the conversion factor that they use is not really perfect, because when the assumption, the underlying assumption is that all the coupon will have the same maturity, same kind of bond with the same coupon, obviously different coupon amount, but same interest rate. That doesn't happen in the real world. Right? So I'm saying that had that been the case, my investors, sorry, the person who is shorting would be indifferent between any of the bond. If every bond is same, why is the whole concept of cheapest to deliver? Does it make sense? I'm saying if all the bonds that I'm using are same, A, B, C, D, if all the bonds are same, the assumptions are same, then why are you calculating CTD? It clearly means that different bonds have different things and different characteristics.
Yes.
That is the whole reason of why you are trying to give away the bond that will bring you maximum profit or minimum loss.
So basically, the cheapest to deliver bond is that which has the lowest conversion price or the highest?
So it all depends. It all depends on the overall situation of what the settlement price would be.
Okay.
Right? So I'm saying just looking at a conversion factor will not be a right way to say that
And the
I would be doing
settlement
something.
and the settlement price is what exactly? Is what
So
I'm
the
not.
settlement price is that current value price at that moment.
Okay.
Right? So I'm saying if I am going to get into a contract, then we would know that at that point what would be the price of that contract. That would be the settlement price. Okay. So I'm saying, is it right to say if we are so far so good, and let me just create a column over here so that we would know the formulas and keep them handy. So what we understood so far is that my price that my short is going to receive will be given by future settlement price by 100 multiply 100,000, because that's the face value of a treasury bond, multiply conversion factor 1. Second, that my total amount will be equal to my price, right? Your book says principal invoice price, but I'm just using the word price, plus accrued interest if there is any. And also, this is something that I'm going to receive. The person who is short, this is the amount that who is going to receive. But how about his effective profit or loss? So can I say that the effective profit or loss would be this amount?
Yeah.
Minus this amount that he's going to get. The person who is short, he will receive this.
Yeah.
Right? And what he's going to pay? So I'm calling it as A, the total amount. So his total profit or loss would be given by A minus this amount that he received, right? But obviously he will have to buy the bond and deliver, right? So it will be the cheapest to deliver price.
Yeah.
Plus if there is any accrued interest, it's the same thing.
Okay.
That will be my profit or loss. Again, think about it as a normal transaction, that I will be receiving this much money, right? And I will have to give away a bond, and that bond price would be the cheapest to deliver price, and if there is accrued interest. So my effective profit or loss would be the amount that is received and the amount minus the amount that is paid. Does it make sense?
Yeah.
Okay. Let's just try to solve a question. Let me write these things on the screen so that
Yeah.
you will have the formula handy over here. So the question says that there are two bonds, bond 1, bond 2, and this is the coupon, it is 5.5, and this one is a 5.75. Your time to maturity, in this it is 20 years, it is 19 years. Bond price, it is 141.13, 145.10. Accrued interest is taken as 0. We assume that it is being at a delivery. Conversion factor, it is 0.9422, and this is 0.9719. And finally, the future settlement price, it is 148.75, 148.75, same. Right? So let's just try to understand our profit or loss. So basically, you have future settlement price, you have conversion factor,
Yeah.
you have accrued interest, right?
Yeah.
And this is your bond price, as in your CTD price. So I think you have everything. Just try this and let me know.
When I do the P&L loss thing, so suppose I'm doing it for bond 1. I do 148.75, which is the future settlement price, divided by 100 into 100K into the conversion factor.
Right.
So that comes to 148,750 multiplied by 0.9422, right? But that number will be much greater than just the CTD price of the bond, which is 141.3. Like, am I supposed to multiply 141.3 into 100K?
Yeah. Yeah. It's the same thing, right? Apples to apples comparison.
Okay.
So think about this, right? You don't want to do it, then don't do it on both the things. You want to do it, then do it on both.
Understood. Understood. Understood.
So
And when these
effective is that effective, there are 5 zeros here and there are 2
mm-hmm.
zeros over here. So either, let's say you don't want to do anything, then don't do anything anywhere, because ultimately you are subtracting,
Mm-hmm.
right? If you're doing it, then you will also do it over here.
Very clear.
100,000.
So in the first one, it's a loss of minus 977.75. 977.75 is the loss.
Okay.
In the second one, it's a loss of minus 529.875. So you'll pick bond 2 because you want to minimize your losses.
Perfect. So getting a hang of it, कैसे करना है, क्या करना है?
Just tell me how this future settlement price is calculated. This I don't understand.
The future settlement price
Is it?
is basically,
Yeah.
first of all, it's not getting calculated. It will be given to you
Ah.
always.
Okay. Okay. Got it.
Yeah, you never have to calculate this.
Yeah.
But also, let me tell you giving you some background. So when it comes to future settlement price,
Yeah.
so it is like the today's price, today's in today's time,
Yeah.
setting up a future value,
Setting up a
right?
future value.
Yeah.
Got it.
So when any contract is being done, think about this. So we say that let's lock in the price today. That
Yeah.
after 90 days, I will be paying you or taking away amount from you at this amount.
Yeah.
That's the reason you would see that this amount is same in both the two cases, while this amount is different because that will be the actual price on that day.
Mm-hmm.
So this is like the locked in price as of today,
Okay.
and this will be
Okay.
the
Okay.
actual
Okay.
price
Okay. Okay.
as of that day.
Okay. 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 So it's basically like you're just setting a price. It's like a future. That's what it means.
Absolutely. For any
Yeah.
contract, that will be to try to lock in the price, right? That I will be paying
Okay.
you or I
Got
will be getting it at this amount.
it. Got it.
So this will then be same. But then
Got it.
on that day itself, it will be different. It will be different because that will depend upon the spot rate.
Mm.
Make sense?
Makes sense.
Okay. So you would realize that these fixed income questions are little bit lengthier,
Hmm.
but effectively they're all formula based. You know the formula, you can solve the question.
Yeah.
A lot of information in the question, but then everything will be given to you. And if you know how to plug in those numbers, you will be able to get the right answer.
Hmm.
Now let's extend our discussion on the same topic, a little bit more conceptually, and tell me something that if I have a long bond portfolio, right? And to hedge it, I can sell treasury futures, right? This is what we have discussed so far. Yes, if I
Yeah.
have a long bond portfolio,
You'd want to. Yeah.
if I want to hedge my position,
Yeah.
I can sell treasury futures, right? So
Yeah.
can I say, and we talked about that we will be doing it using cheapest to deliver, etc., whatever.
Yeah.
So can I say that
Yeah.
to fully hedge my position,
Yeah.
my change in the futures price multiply the conversion factor, because different bond will different conversion factor, will
Mm-hmm.
be similar to my change in the cheapest to deliver bond. Can I say that? My change in the future price, because this will be set initially, the future settlement price, and then for different bonds there will be different conversion factors. That's how, because that's something that I will be paying, I will be getting as a short position, and this will be something that I will be paying at the end.
But how can they be
Effectively,
equal?
sorry,
How can they be equal?
I want it to be equal because I want to fully hedge my position.
Oh, okay, okay. This is something you're setting. It's not a
Yeah,
conclusion. It's something you want.
it's not a conclusion, but
Yeah.
isn't this the something that I want?
Yep, yep, yep.
So I
Correct.
really have to fully immunize my position, that all I want is that whatever I'm going to pay is whatever I'm going to receive. Effectively, my net profit or loss would be zero, and I will fully hedge my position.
Yeah,
Right. So can I say that if I really have to look at my change in my portfolio value,
yeah,
will be equal to some kind of a hedge ratio, that I don't know for now, multiply my change in futures price. So what I'm
Yeah.
trying to say is that I am trying to calculate some kind of a hedge ratio, right? That will make it immune to any kind of change in the future prices and will take care of it plus minus here or there,
Yeah.
right? And can I say that this hedge ratio is kind of number of contracts that I'm looking at? How many contracts should I buy or how many contracts should I sell so that I just immune my position?
Mm-hmm.
What we studied so far is that okay, if I have to sell one bond, one cheapest to deliver bond, then how much profit or loss am I going to make? Right? Something that we discussed over here.
Mm-hmm.
But not now, what I'm trying to understand is how many such future contracts should I buy? How many such future contracts should I buy or sell accordingly what I want to take the position on? Effectively, I should be able to hedge my position over.
Yeah.
Right? So I'm saying matching the portfolio value will be equal to a kind of a hedge ratio which has been given by number of contracts multiply the change in the future prices. So I would
Yeah.
know that for whatever change in my value, it should be equal to my change in the future prices.
Yeah.
And that's how I want to get some kind of contracts. Right? Is that okay?
Yeah.
Now, can I say that my change in the future price will be given as hedge ratio multiply change in the future price being given by change in my CTD upon conversion factor from this formula we just discussed.
Change in CTD. Yeah. 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 Yeah.
I
Yeah.
just derived this from this.
Yeah.
So change the
Yeah.
future price will be given by change in CTD by conversion factor.
Yeah.
So can I say I'm just rearranging these things and can I say that the number of contracts
Yeah.
that I have to buy or sell
Yeah.
that will be given by change in my portfolio value, and I'm bringing this over here, and this is if I'm taking it over here, can I say that this will be given by multiply, this will be opposite of what we just discussed, right? Conversion factor divided by change in CTD.
Yeah.
Is that okay?
Yeah.
So
So,
first of all,
can you just explain, like, in reality, what this means? So, number of contracts to hedge is equal to change in portfolio value. Mean, what do you mean by that? Like, that we are expecting, like, say, 10% movement in the portfolio value. So, for that, how much I have to hedge? Is it?
yes, absolutely, absolutely. So the point that I'm trying to say is, let's say my overall bond portfolio value is 100,000.
Hmm.
Then I would say for every 1% change in the 100,000, how much contract should I buy to hedge my overall position?
Okay. And the denominator, which is the change in CTD, is what?
The change in the denominator.
Yeah, but like, what do you mean by the change in CTD? Is it like the
Yeah.
change happens like over time, or?
No. Obviously, it's a good question. So basically, we look at it's a basically 1 basis point change in yield.
Ah, okay. Okay.
And I said change because everything is interest rate in this fixed income.
Right, 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 right.
So and even for change in the portfolio value, we are doing again, we are still again
Same.
considering this one
Yeah.
bip change in the portfolio value.
Yeah, yeah. Got it.
And obviously, with number of contracts that we are going to buy, we will multiply anytime,
Got it.
right? But again, there's one more point. The last point that I'm trying to make, and then we will solve a question, is think about this. we talked about this, that the conversion factor is not the perfect thing to do, right? So when the conversion factor is not perfect, it means that the cheapest to deliver bonds is not a perfect calculation. Is that the right way to say?
Yeah.
So when we assume that the cheapest to deliver calculation is not perfect, and there will always be some kind of a basis risk, right? So you understand what a basis risk is. Basis basically means the bips, the change.
Yeah.
Right? Or I can say that the spread
Yeah.
risk.
Oh,
When
got
you
it.
know, right? When you know, and also, right? You think about this, that cheapest to deliver bonds, you are working on which? You are working on futures. On a cheapest to deliver bond, everything that we talked about, Treasury future bond. Yes?
Yeah.
They are standardized products.
Yeah, standardized products. Yep.
Right? So you might want to work on a 1.5-year bond, but the available bond that you have is for 1 year. So somewhere you are using a substitute. You are using a substitute to just work around because you don't have another product for 1.5 years. Is that correct?
Yeah.
It
Correct.
means that the cheapest to deliver bond that you're looking for is not the exact bond that you're looking for, but a substitute of what you wanted.
Yeah.
It means there will be some kind of error. All this background that I'm telling you is not to solve a question, but to tell you that the hedging will not be perfect. The whole idea of telling you all of these things is the main point, that hedging will not be perfect.
Yeah.
Right? And if the hedging will not be perfect, then rather than looking at this whole scenario overall, let's just try to understand how much, how many contracts should I buy for a change in the bips. Let's just work around in terms of bips. And obviously, I even show you that there will always be mismatch as in you will still be not be able to buy exact number of contracts by yourself. We'll tell you how and why. But they say that when there is a basis risk, right? And when you know that the portfolio might not only have CTD bonds, because you're looking for 1.5, but the available is only 1 year. So you might
Yeah.
not be able to buy the treasury or maybe look for some other products. So the
Yeah.
CTD or conversion factor is not perfect. So they say, let's just try to understand how my portfolio is going to change with only in terms of 1 bips, right? So they use the same formula per se,
Yeah.
but they just change it a little bit in terms of bips value. So by that they mean that instead of HR, they use the word BPVHR, which means basis point value hedge ratio.
Okay.
The idea is still the same. It's still the hedge ratio. It's still the number of contracts, right? And if I'm a long, and this will be given by change in the portfolio. So can I say that it is basis point value change in the portfolio? It's the same thing. And again, even for this, it is going to be basis point value change in CTD multiply conversion factor. Have I changed this formula at all? So instead
No.
of changing the value, I'm looking at a basis point value change.
Yeah.
And in your books, they have used a negative sign over here, but it just simply shows that if you have a long portfolio, then you will short the futures, right? Hence, they have put the negative sign over here. It means that you are selling the number of futures. And can I say now that a BPV portfolio is being given by, how do we look at in terms of change? When it comes to change in the interest rate, we look at a modified duration.
Yeah.
We look at a modified duration, the modified duration of portfolio, multiply, I said 1 bips change, multiply the market value of the portfolio. Right? And can I also say that the BPV of a CTD is being given by modified duration of CTD, multiply 1 bips change, multiply of CTD. And how do we calculate a modified duration of a CTD? Something that we already know from background is the CTD price upon 100 multiply 100,000. We talked about it, right? Before. Per par value multiply 100,000 of the treasury futures. Little too much of information.
Yeah.
Yeah, to absorb, I understand, right? But the idea here is that we are trying to look at how many, and you will get a lot of questions on that a person has long this portfolio, and he or she would like to hedge the position. How many contracts we buy or sell? So you would know that somebody is long, then you will have to short the position. Somebody is short, you will have to long the position opposite, obviously, to hedge. And then how you would have to calculate the number of contracts is being given by this.
Yeah.
Right? That's the ultimate formula that you need to remember instead of all of those things. Right? And even in that, sometimes they also ask you a question that they want to achieve a specific duration. They would want to achieve a specific duration. So in a simple terms, I can tell you that this is my final minus initial by reference, right? Multiply conversion factor. When I say final minus initial, is in that if I say that my target duration is, let's say, BPV of T, or the target, right?
Yeah.
Minus the BPV of the current portfolio upon the reference would be the BPV of CTD multiply conversion factor. So you would see that this formula and this formula is no different. It's just that I'm using a 0 over here for now, that the target duration is 0 that you want to look at. But let's say they give you a question where they say that you want to achieve a target duration of X, then you can insert this over here and the formula will still be same. Let's just do one thing. Let's just try to solve a question.
Yeah.
And then you will see how exactly does it work. Okay. I'm giving you all the information over here itself so that you don't have to. Let me just see. I'm removing this because that's not really relevant. And in fact, let me write this for you. Something that we discussed is, these formulas. And one thing that we said is modified duration of a CTD has been given by CTD price on 100 multiply 100,000. Now let me write this question for you. So basically, and I will also make you.
Duration of CTD is CTD price divided by 100 into 100K.
There is something that we discussed before, right? For a treasury bonds, it has been given as CTD price was given per par, and for the treasury bonds, the face value is 100,000. Look at this one.
It's independent of the yield.
It is independent. No, so the yield I'm taking care of here. The for a modified duration for a CTD, it has been given by this, and that's 1% change in the yield.
Okay.
Multiply the total value of the CTD.
Okay.
So we are not really looking at 5% to 6%. We are looking for a 1 bips change only. Right? And if I can get value of 1 bips in, then I can always multiply with the number of contracts I have to buy and to hedge the overall position. Okay. All right. So I'm saying the question goes as, and I'll make you read the language as well later, so that you will also know what kind of language that you can see in the exam. But I'm saying, let's say a market value of the portfolio is 60 million. Somebody wants to hedge the portfolio fully, and it has a modified duration of portfolio as 10.75, right? And obviously somebody has a long portfolio, so he would be selling the futures, right? For when it comes to futures, the futures price, it is 130.21. Contract size 100,000, we just discussed already, right? CTD coupon, it is visible, right?
Yeah.
Okay. 4.75% coupon. Time to maturity. Well, yes, you would also realize that they give you a lot of information which is not being used. Right? The CFA does a good job in doing it. The CTD price is 139.56. CTD conversion factor is 1.0709, and modified duration CTD is 9.7. Right? So they give you modified market value of the portfolio, market value, modified duration of the portfolio, future price, size 100,000, CTD value, the coupon 4.75, time to maturity 12 years, CTD price, CTD conversion factor, modified duration of the CTD. I can in fact tag you what's what, but I want you to try this first, and then we'll look at this together. There's a lot of information. I hope you have a pen and paper to solve.
Yeah.
Take 5 minutes. I'll be right back.
Yeah, good. Hello. Yeah, I'm completely confused here.
Completely confused. Okay, perfect. Expected. So let's do one by one, okay?
Yeah.
Just try to solve what we can solve easily. What are we trying to do here? We are first of all trying to, they didn't talk about anything in terms of target BPV or something.
Right? They didn't. No. Yeah.
So let's just talk about, can we calculate BPV of the portfolio? It is being given by modified duration of the portfolio.
Yeah, 10.75 into 0.01% into 60 million.
Perfect. So you're done with half of the question, right? What is the conversion factor?
Conversion factor. Conversion factor is 1.0709.
Perfect. So you know this already?
Yeah.
You know this already?
Yeah.
And let's just calculate this.
Yeah.
So in this, what does it say? Modified duration of CTD.
Yeah.
For a
That's
modified duration of CTD, you have
9.7.
CTD price. What is
Oh,
CTD
okay. I have CTD price is 139.56.
price? Perfect. Divide by 100, multiply 100,000.
Yeah, but you've also given MD CTD, right? Is that different?
I gave you empty, yeah, modified duration of 9.7.
Right. I think
Okay.
we just didn't have MB CTD.
Oh, we already have modified duration, right?
We already have modified duration, so 9.7.
Okay, yeah, we already have this, but we don't have MVCTD.
Correct.
Oh,
Correct.
did I just give you a 1 second? Oh, this was a market value. My formula was wrong. This is the market value of the CTD. My bad.
Got it. Got it.
Value of the
Then
CTD.
that makes sense.
By CTD price by 100,000.
Got it.
This is in terms of the price, the market value. Yes,
Yeah.
not the duration. So when it comes to market value of the CTD, you have the CTD price
Yeah.
139.56 divided by 100 into 100,000. So that will give you this value. So you have MVCTD from here.
Yeah.
Now you have this, you have this, you have everything. Now tell me.
So 139.56 divided by 100 into 1,000. I'm getting the BPV HR as, I don't know if this is correct, but minus 510.
Minus 510.
No, not
Okay. No. Let's just see. What is the BPV of portfolio?
it's 10.75.
No. What is the final value?
Huh?
What is the final value after
Yeah,
calculation?
once. So it's 0.069.
Are you really doing 10.75?
Sorry, I'm also multiplying the conversion factor. But yeah, 10.75 into 0.01% into 60 million. Oh, wait.
And there's a reason why I wanted to reach a specific number here. I'll tell you why later.
Hmm.
But give
Okay,
me the
just
exact number.
yeah. Yeah, I don't know if this is also correct. 64,500.
Okay, great. This is right.
Yeah, I can't hear you.
You can't?
Hello?
Hello? You can hear me?
Yeah.
Okay, you can hear me, right? Yes, it is
Yeah.
64,500. This is correct.
Yeah.
How about BPV of a CTD?
Just telling you that. That's 135.37.
And lastly, what would be the hedge ratio?
510.25.
Are you using the conversion ratio as well?
Yeah. Or
So
should
all you
I?
need to do,
I can't hear you again. It's gone feeble.
what happened?
Yeah.
You can't hear me?
I can hear you now. Yeah.
I don't even know if there's a mute option that I'm accidentally pressing.
No, it's just the voice is becoming like softer. So I don't think
Oh,
it's
okay.
any.
Okay. So I'm saying that all you need to do was it was 64,500
Yeah.
divided by 135.37
Mm-hmm.
sometimes discussed multiply 1.0709. Is this what you did?
Yeah.
How much this value would be?
Got 510.25. Let me just do it again. Yeah, just got that. 510.25.
510.25. Now, this is a very important result that I wanted to talk about, and why I'm emphasizing on solving, making you solve this towards the end, is because can you see that 510.25 actually translates to 510? Obviously, you cannot have 0.25 futures, you can have one, right? So a simple rounding off, if had it been 510.75, you would have said 511.
Yeah.
Can I say that you are effectively selling or shorting 510 futures? Is it right to say?
Yeah.
Effectively, you are selling 510 future contracts? Yes or no?
Yeah.
But but how much were you supposed to sell? You would be shorting, you are short 510 futures, but how many futures were you supposed to sell? 510.25.
Mm-hmm.
This was the actual number to fully hedge your portfolio. Is that correct?
Yeah.
This number was the exact number to fully hedge your portfolio, which
Yeah.
clearly means that if you are selling only 510 futures and not 510.25,
Yeah.
it means that your hedging is not perfect,
Mm.
right?
Yeah.
So you can get a question theoretically as well somewhere, that why hedging is not perfect,
Mm.
right? So you can see that the number of contracts in this case is not the exact that you want to hedge, and hence there will always be a basis risk.
Mm.
Always be a basis risk, because it is because you are assumed. Basically, the simple thing is that instead of 510.25, you are actually selling 510 only. Is that clear? Or is there any doubt in that?
No. No doubt.
100%?
Yeah.
So can I say, and okay, let's just solve one more thing. Instead of this, everything else same. Instead of I said that I want to hedge my position, what if I say that I want to sell some futures to achieve a target? I want to sell some futures to achieve a target duration of, how much was the target, the duration over here? 10.75. Okay, let's say
Yeah.
I want to target duration of 9. Everything else same. Then how would the calculation would move? So can I say that everything else same, your BPV of target will now be 9 multiply 0.01% multiply 60 million. Portfolio value is still the same.
Yeah.
1 bps change, but a target duration of 9. Right? So
Yeah.
let's say this comes out to be X. Let's say this comes out to be X. So can I say that the number of contracts that I want to sell now would be X minus what you already did, 64,500 divide by 135.37 multiply 1.0709.
These are the number of contracts you have to sell.
Yeah, everything else same. Whatever you did in the last question, I just added this part now.
So
That what is
this X will actually be lower, so the numerator will be negative, so you have to buy contracts, is it?
no? So this has already been the equation, right?
Yeah.
You were anyway selling.
Okay.
So think, okay, let me just re-clarify this maybe. What was the original duration of the portfolio? Was it 10.75?
Yeah.
Right? The original duration of the portfolio was 10.75.
Yeah.
We assumed that you want to fully hedge. It means that the target duration is actually equal to 0.
Yeah.
Right? So we were effectively selling the futures.
Oh, got it.
Now this time saying I am targeting my duration to 9. I'm still selling the futures, right?
Yeah.
Only and only if I say that I want to increase my portfolio duration to 12, which is more than 10.75, that's when I'm going to long the contract. As long as my target duration, whether it is 0 or 9 or whatsoever, less than 10.75, I would be selling the contract, right? Let me know if it doesn't make sense. Shall I re-explain the whole thing?
No, I got it. Got it.
100%?
Yeah, 100%. So when you're hedging, you're making it completely zero.
Yeah, when I'm hedging, I'm making completely zero.
Correct.
But in case I want to achieve some target duration, which is less than this, obviously I'm selling. If I want to achieve more than this, I'm buying.
Got it.
Now, let's just quickly read the question. And this is only to give you a background on how the language looks like. Look at this. A fixed income portfolio manager is holding a portfolio worth 60 million GBP and wants to fully hedge the portfolio. Against one important word that I wanted to mention, and that's the reason I wanted to read this, against parallel movements in the yield curve. Why does it say it? It comes as a assumption because in all the formulas, which duration are we using? The modified duration.
Modified duration.
And if you remember from CFA level 2, modified duration captures the parallel movement. And in case you have a non-parallel movement, let's say steep or curvature, first of all, it is difficult to estimate. And in case you really want to estimate, then you also have to look at another component, which is convexity.
Yeah.
Right. But then that will make the calculation too difficult. So the assumption here is to hedge these portfolios, we assume that the movements are parallel.
Yeah.
This is a basic assumption. So you are not going to get any question on non-parallel movement. So even if they say it, they don't say it. But the idea is that you are assuming that the movement is parallel, and hence you are then calculating the number of contracts that you should sell. Is that clear?
Yeah, clear. Yeah.
Okay. So can you see?
Yeah, the parallel
So it says
movement.
They talk about parallel movements, and then they say modified duration of 10.75, and he wants to sell the futures, gilt futures, to hedge the portfolio, right? something that we just discussed. And then it also says that how about that he wants to achieve a target duration of 8.7. What we solved for 9, but the idea is as long as it is less than 10.75, you will still sell the futures.
Yeah.
Clear?
Yep.
One more thing that I want to talk about importantly, yeah, are these 3 points very, very important. And these are testable in the exam. Something that we already discussed, but let's just read them together. Can we see that the hedge was constructed using the CTD, right? If the level or slope of the term structure of interest rates changes significantly, look at this level or slope, right? The eligible bond CTD would change. If CTD would change, the duration of the CTD would also change, right? So we are assuming that the interest rate does not change significantly. This is first assumption. And then they say the hedging results are not perfect, what we
Yeah.
discussed. Second, we said that duration is not a perfect measure of how bond prices react to interest
Correct.
rate changes. We talked about this. We ignored the convexity, right?
Correct.
And also, the modified duration only captures the impact of parallel movements, as we just said, right?
Yeah.
Shaping risk refers to non-parallel movement, that's a steepening or flattening or changes in the curvature.
But
We are not
basically,
saying.
shaping risk is convexity captures it, right? But I don't
Yeah.
understand how point 2 and point 3 are different.
So point two, it says that duration itself, we talked about modified duration, but basically this is like a subpart of second,
Yeah.
where they say that duration itself as a parameter is not perfect of how, if I say that I want to capture my changes in the interest rates, which
Yeah.
measure should I use? Then it says duration is not the right parameter to use, right? So in general, it says that it doesn't take care of convexity. The best measure
Yeah.
of looking at change in the interest rate, you should capture both duration and convexity, which is not taking. And then it says that what is the reason of why it is not a perfect measure is because modified duration only captures the parallel movement, right? And let me tell you that I think steepening, flattening, barbell strategy, all of these things are bullet barbell strategy is in your CFA level 3 if I'm not wrong, not CFA level 2. I'll just check. Okay.
Yeah.
But the
I'm
but
aware of bullet and barbell, I think.
do you have barbell in level 2?
Yeah, I think we did.
Oh, okay. So when you have this in level 2, so you know it, right? That it only captures a parallel movement and effectively, if you look at high level steepening or flattening, even convexity is not the right measure. Even you know that.
Yeah.
Right? So even when it comes to these things, we only assume a very small movement. That's how we capture. But then these things are theoretical. Don't worry about these things. The idea is that we are assuming here it's a parallel movement, and hence we are using modified duration, right? And if the interest rate changes significantly, it doesn't work. And fourth point that I already told you and will be tested somewhere else is because the hedging is also not perfect because there is a basis risk. The
Yeah.
number of bonds that you are selling, the number of futures that you are selling is not exactly equal to that you calculate to hedge the overall portfolio, and hence there will always be a basis risk.
Yeah. So I think it's A because he would engage in the swap only because he kind of wants to hedge something, right? So he wants to set the payment he receives. So that's why I thought it was A. Otherwise, it's a bit confusing for me.
The question says Ben Root holds an interest rate swap with a tenure of 1 year and quarterly settlement dates.
Yeah.
Right? The variable reference rate is the floating market reference rate (MRR). The variable payment or the receipt on day 270th
Mm-hmm.
be determined by. So it says, what does it say? It's a quarterly settlement dates. Okay. What does that mean? That it means that if I have at t equal to 0, this is 90, this is 180, This is 270 and this is 360. Okay. So what happens is in a quarterly settlement date, you always know the rate of interest on this date as of this date, right? You would not know what would be the rate as of 180. You would not know. You
So
would
at
not know
quarterly
what would be
settlement,
the
sorry, can
rate.
you say that again? The first part?
Sorry.
The first part, can you say again? At t is
Yep.
equal to 0, you'll know what the interest rate is at t is equal to 90.
Yes. Yes. So when it is a quarterly settlement, you will know for the next quarter what will be the rate of interest. That's how you fix it. But you will not know what will be the rate of interest for 180 days, for
But
270 and
I thought the interest that will be paid to you will be you can only decide like you'll only know on t is equal to 90, whatever the reference rate is. Is that not how it works?
yes, it does work. But then that's how you get to know at t equal to 0 at what rate are you going to settle at t equal to 90. Come again, repeat your question.
No. So suppose today
Mhm.
the reference rate is at 5%. Okay. And suppose there's no spread or whatever.
Mhm.
In 90 days, the reference rate becomes 6%. So I should be getting essentially 6 divided by whatever 4.
Mhm.
So that will be my payment, not 5 divided by 4, right?
Okay, let me explain this. So when you say that reference rate is at 5%
Yeah.
and it turned out to be 6%,
Yeah.
when I say it is going to be 5%, we were also saying that let's just fix the rate 5% at this point itself. Although we were deciding over here, but we were deciding for this date itself. Think about this. Had this been 5% over here and 6% over here, how can we subtract these two numbers? Right? So जब हम लोग बोलते that we decide on if it is 5%, so which is 5% is not as of today, but it will still be of t equal to 90. But then we lock in the price, but we don't know what the price would be at that time.
Okay.
Right? So when the price on that day, so basically my 5% is like fixing for future
Yeah.
at t equal to 0, right? We are fixing at t equal to 0, but then the price interest rate will be of t equal to 90. But
Yeah.
then this is like the future, and then when the spot comes at t equal to 90 on t equal to 90, it will be 6%. Then I would see that whether I am long or short, and that's what the 1% payment would go, which is a difference between 6 and 5.
Mm.
Understood?
Yeah.
And then on 90, I'll again say that my 90 days LIBOR would be, let's say, something, and we fix a rate. And then we again look at date on 180th day and say that, okay, the rate is this much, so let's just do a plus minus of that. Right? That's the reason, that's the main reason of why we have a quarterly settlement. Can you see that? It is a tenure of 1 year and quarterly settlement dates. The variable reference rate is the floating market rate reference, and the variable payment on the one is, we'll come back to this.
Yeah.
Or 270. But are we okay to understand how the interest rates is being happening? We looked at the next payment date and we set a date, and then we see what the price would be on that date. Is that clear?
Yeah.
And let me tell you, this concept is not for this question, but this concept is everywhere for whole FRA and whatever contracts that you look at, it's the same concept. Okay.
Yeah.
Now look at this. It says the variable payment receipt on 270th day. अगर कोई मुझे पेमेंट इस दिन की देखनी है,
Huh.
right? So when I should decide?
180.
Should I look at 180? Sure about that, right? So
Yep.
if it is the payment on 270th day
Yeah.
will be determined by 90 days IRR, MRR at day 180. So we decide over here what will be the price for this. So the answer here would be C.
Hmm.
Okay. Give me
Yep.
just one moment. I'm going back to in my book. I'm going back to FRA, and
Yeah.
I just want to see if I can show you same thing somewhere else.
Yeah.
Can you see this? We solved this question using an FRA to hedge short-term future borrowing, where we said that calculates the firm borrowing cost on the loan net of FRA payment for realized 6 months reference rate values 90 days from now of 7% and 3%. 90 days from now. So they say that I am at t equal to 0, right? And I am fixing a rate somewhere else. Look at this, MRR plus 50 bips or whatever,
Hmm.
right? I'm not getting into the question right now, but they say that what if the price would be 7% and 3%? What if
Hmm.
the interest rates would be 7% first scenario and 3% second scenario? But what we are fixing, look at this, needs to borrow this many days for 180 days, 90 days from now. And the market reference says it, MRR plus 50 bips. The company is concerned that the interest rate will rise and he would want to fix a rate. Look at
Yeah.
this. Smith takes a long
5%.
position in an
Hmm.
FRA, 6 months reference, 90 days in the future with a forward rate of 5% annualized. So he
Hmm.
say that he's trying to fix a rate today, but obviously this 5% annualized, which will be adjusted for semi-annual payments, but I'm referring to 5% adjusted versus these numbers, right? So whatever interest rate that we are referring to has to be at the same point in time, but will be discussed one period before itself,
Understood.
right? That's the reason you would see a questions when they ask you that I have a, this is t equal to 0, this is t equal to, let's say 360, this is 180 semi-annual payments, and I take a offsetting position over here. So this was for 360 days, and I took a offsetting position over here, right? And then I say what will be my profit and loss today. So whatever interest rate that we take and we do a netting, we
Yeah.
bring it back. So what we say is that I am at 180th a day, right? And I'm taking offsetting position. But do you still remember? Do you still remember that the to calculate the profit and loss, how do we calculate? That we think that if we are going to get 6%, and we take a short position at, let's
Yeah.
say, negative 7%. So whatever 1% loss that we take it, we bring it back at this moment, right?
Hmm.
Although we are deciding everything over here, but the assumption is that the actual transaction will still take place. Although we are taking offset position at 180th day, we assume that the actual transaction will still take place on 360th day.
Yeah.
So to calculate my profit and loss as of today, I'm still bringing it back my whole profit and loss from 360th day to 180th day,
Hmm.
right? So you might argue that Ankur, I am doing it offsetting over here. Then why am I looking at this? But I'm doing the offsetting, but the effective offsetting will happen only at the maturity.
Got it.
Does it make sense? 100%?
Yeah. I'll have to sit and like see this again. I think
Yeah,
that's
yeah,
the
yeah.
new.
But
It's
then
a
I'm
bit
saying,
like I'm understanding parts of it, but like
Mhm.
just to connect the dots.
Okay. But I'm saying in case you still feel that you're confused,
Yeah.
do come back to me tomorrow and ask me.
No, I will do that definitely. So today I'll spend at least good 1 hour, 1.5 hours. Just I have written notes, so I'll just go over those. Yeah, but it's a bit like a lot, yeah. But
Let's just try question number 3 before we
yeah,
proceed.
yeah.
Basically, question number 2 is simple one. I know you can do it. It's simple FRA swap,
Okay.
and you would know it's a pair swap or something. So I thought let's just try question 3, and you would know.
Yeah. Answer is A.
And how many actual contracts did you get?
What one?
How many actual number of contracts did you get?
334.72.
Okay, so you know, right? How did we round off?
Yeah,
We made it 335.
yeah.
Okay.
So this
Uh,
this futures price was not needed.
mhm.
This futures price was not needed.
Futures price was not needed. I'm thinking in a BPV of portfolio, so you didn't use anywhere.
No, so I no, I did. So I did. First thing I did was BPV of portfolio using modified duration of 12.
Right.
For that, I
Which
didn't
was
need
what number did you get over there?
240,000.
Okay, perfect. Uh-huh.
Then for 8, it is 160,000,
For 806,000. Okay. Mm-hmm.
right? Then my denominator, basically, which is the BPV of CTD, is 183.77. For that, I didn't need futures price. I just needed CTD price to calculate MV of CTD.
Mm-hmm.
And then that I multiplied by the conversion factor.
Okay, perfect.
So in this, I didn't use futures price.
Yeah. So it is not required.
Yeah, got it.
Not required. Okay. So now you're comfortable with these kind of calculations?
Yeah.
Okay, perfect. Uh, the next topic, actually, I'm thinking to just start the next topic tomorrow itself. Then,
Yeah, let's do it tomorrow. I think it's been.
okay. So what my expectation is that I think my assumption is that you are okay with what was taught today, but then I think you got a little confused with the interest rates on which date is used,
Yes,
right?
correct.
So
Correct.
I would say at least spend some time on that to understand if
Okay,
you're
perfect.
comfortable with interest rate thing, right? And revisit what we discussed today.
Yeah.
And tomorrow we'll start with currency swaps and we'll take it from there. And then
Yeah.
tomorrow is Friday, so let's just discuss how do we want to
Yeah.
utilize our weekend,
Yeah.
right?
Mm.
And okay. I mean, it is going to be too far if we're going to talk about the next week, but let's just discuss this tomorrow.
Yeah. Next week, only thing is I'm in Sri Lanka, so let me just get back some of like work thing. I should be free in the mornings, but I'll just get back on everything by Friday.
You
By
will be in
tomorrow.
Sri Lanka for the whole week.
Yeah, till Thursday.
So from Monday to
Thursday.
from first to fourth, from first to third,
From 30th to
30th
3rd.
to third,
Yeah.
right?
But let me just
So I
get
think
back to you. I think it should be
absolutely.
very fun.
I mean, just out of curiosity. So basically, you go there and you meet the clients and to understand what the company. Well, what's the role over there when you visit the client in
No,
different
no,
countries?
we aren't like we don't visit clients. We since we're an investment firm, this is like within the firm only they are hosting an offsite. It's
Oh, they're
firm
also.
off.
That's an offsite. Okay, I
Yeah.
understand an offsite. Okay, but they do it in Sri Lanka.
They do it all over the place. So this year it's in Sri Lanka. I don't know why they do that, but they do.
Nice, because a lot of companies that I know, they usually do it in somewhere in India. They do a offsite,
Yeah,
but they do it somewhere in
but
India.
this is the entire Asia team. So it'll include people from Singapore, Hong Kong. That's why.
Okay, all right. Let's just discuss this tomorrow and how do we go about it.
Perfect.
Okay.
Perfect. Thanks.
Thank you, Arav. Have
Yeah.
a good one.
Bye.
Bye.